All right, so let's check out your chapter 4 homework. This is problem number 1, and it looks like we got 3 adjustments. So on problem number 1, we've got the Service Pro Corp, SPC. They're doing their September 30th year-end financial statements. So we're doing this for the end of September 30th. We've got 3 potential adjusting entries, starting with the first one. So we got prepaid insurance, says they got a 0 balance at September 30th, but the insurance expense has a debit balance for $23.40. And this represents the cost of a 3-year policy purchased on September 1. So essentially what they did is when they bought the policy, they went ahead and just expensed it. They just put it all to insurance expense, and they shouldn't have done that. So we've got to go back and figure out what is our monthly expense. So if you take out that $23.40, divide that by 36 months, you get right at $65, and that of course would be per month. So the difference between $23.40 and $65 would be $22.75 is how much you have unused. It's basically what you haven't used up. So on your adjustment, you have to go in and make an adjustment. So you're going to go ahead and debit prepaid insurance. You want it to have a balance of $22.75, and then you're going to credit the insurance expense by $22.75. And then, when you do that, your net effect would be that you are actually going to be expensing $65 for the month of September. So this is how you would account for this type of an adjustment, where they put everything into an expense account. In this case, you have to go in and you're actually going to be crediting the expense because you haven't used it all up yet. All right, so that would be part 1. Let's check out the second part. We've said August 31st, cash was debited, service revenue was credited for $1,500. This $1,500 related to fees for a 3-month period beginning on September 1. So quite literally, and let me just give you the math here. So we've got $1,500 and it's for 3 months. And so quite literally, we only earned 1 month. So if you take $1,500 and divide that by 3, we know that we're technically going to be earning $500 again per month. The problem is they put all that money into service revenue, so we have to make an adjustment. So what they do is you're going to debit the service revenue for $1,000 and credit deferred revenue for $1,000. Essentially, the net effect is that you're going to be showing that you're earning $500 per month. So if, for example, I drew out that service revenue T account to show you the net effect. So initially, they put $1,500 in there. When we do the adjusting entry of $1,000, what falls out is that only $500 would actually be recognized on that income statement. All right, so that would be how you take care of part B. And then let's check out the third one. They have income tax of 20%, income before income taxes is $10,000, so that's an easy one. You haven't done anything on the taxes yet, so they haven't been paid or recorded. So you just take 20% of $10,000. That's an accrual. Debit your income tax expense for $2,000 and credit income tax payable for $2,000. All right. And down below, of course, they're just going to show you the same thing I just did. I like this illustration. They're showing you for each one of these the net effect of what would happen also in your ledger accounts. Okay. That is problem 1. Let's check out problem number 2. It looks like this is going to be for questions 2 through 4. So we've got the adjusted trial balance, and they want you to do an income statement and then show the net income generated for the year. So remember, on your income statement, all we're looking for is the revenues. So it looks like we've got service or sales revenue and the rent revenue, and then you just look for the expenses. And then so down below, you just have to plug them in. And so notice here's your 2 revenue items, total revenues. You add up all your expenses, including income tax expense, subtract those, net income would be $49.10. And then on part 2, of course, they just want to know what your net income is, and that is $49.10. Okay. Second part is to do your retained earnings statement. So remember, let's go back and check this one out. Remember, this $4,910 gets transferred to retained earnings. So when we go to retained earnings, you know that there's that net income. The beginning balance was $1,000, and of course, go back, there was $300 of dividends you have to subtract. There's your $56.10 on your balance of retained earnings. That's part 3. And then here's your income, here's your balance sheet. And then remember that retained earnings balance then gets transferred right there. Just get your common stock, go ahead and list all your current liabilities. Here's your total liabilities and equity. And of course, plug in your asset amounts. You got 3 current assets and then 1 long-term or a couple long-term with notes receivable. And then of course your equipment. Don't forget to subtract your accumulated depreciation and then notice you should balance. All right, so that would be your classified balance sheet. And I think that's it. And then the last question says, are they assets financed primarily by debt or equity? Just looking at equity, if you look at it, looks like you've got your common stock of 2,400. And if you look at all their debt and compared to your debt versus your equity, it looks like they've got a lot more debt than equity. All right. So that's where they got that one. All right. So that was problem 4. And let's go back up and let's check out now problem number 5. So they want us to do the original entry on A through D and then to do the required adjusting entry. So on part A, looks like this, again, this is for the month of September. They paid the rent on the track for 6 months at $12,000. So debit, prepaid rent, credit, cash. Remember, these are not the adjusting entries. This is just the initial transaction. So part 1's debit, prepaid rent, credit, cash. Part 2 says we got $60,000 as an advance. That's going to be a deferred revenue item. So you'll debit cash, credit deferred revenue for that 60. On letter C, it says we booked the racetrack for a private organization. They're going to use the track 1 day per month to be paid in the following month. They used the track on September 30th. Notice there's no entry. The same thing is when you hire a manager to be paid the first Monday following month. Nothing's actually happened yet. That's just a note entry transaction. So you only had 2 initial entries on the first one. All right. Now on part 2, you had to do the actual adjusting entries. So on the first one, you just have to calculate your rent. So remember how you do that. This is for 6 months. So if you just take that 12,000 and divide that by 6, that gives you right at $2,000 per month. Notice the adjusting entry. You're just going to debit rent expense, credit prepaid rent for $2,000. Part B says we got $60,000 in cash for season tickets for 12-month admission to the racetrack. So again, you just take that $60,000 and it's for a 12-month admission. You just divide that by 12 and basically every month you're going to be earning $5,000. So on part 2, notice you're going to debit service or deferred revenue, credit service revenue for that $5,000. On part C, we are simply booking the racetrack for a private organization to be paid the following month. Again, they're not going to pay us until basically they're going to pay us in October. They used the track on September 30th, so technically they owe us $2,000, so that's an accrual. So you're going to debit AR, credit rent revenue for $2,000. And then finally, in the last one, since we're not going to pay the guy until the next month, if he works for the month of September, we're going to owe him $3,000. So you just debit your accrued expense of salaries and wages expense and credit your salaries and wages payable. All right. So that, I believe, is it. And I got the explanations down here for the calculations I just showed you. That was number 5. All right, number 6. They just want us to go ahead and do some adjustments, or I'm sorry, some entries. So it says for each of the following independent situations, give the journal entry by selecting the code. So they put the codes over here. You can see how they relate to the different accounts. So rather than saying debit accounts receivable, you'd put like code A. That's basically what they want you to do. And then of course, put the amount. So starting with part A, you've got accrued wages, unrecorded and paid. So you'd be looking for a wages expense. That would be letter L for $400. And then we're looking for some sort of payable. Salaries and wages payable would be the credit. Part B, service revenue collected in advance. So in that case, you'd be debiting cash. Let's look for the cash. That's where they get code C for 600. And credit your deferred revenue, which is going to be letter D for 600. Letter C, at the end of the year, interest on notes is not recorded or paid. So this, I'm looking for an interest expense. So that's letter G. That's going to be debited. And then some sort of payable. and they're going to have you use letter H. There's your interest payable for 220. Letter D is depreciation expense. So I'm looking for depreciation expense. That's going to be letter E for 1,000, and my accumulated depreciation is letter B for credit. Letter E says you got service revenue earned but not collected, so we're looking for a receivable. So that's a code A, debit accounts receivable, and then credit a revenue account. They want you to credit service revenue. All right, letter F says balances and supplies was 400. At the end of the year is 150, so the difference is what you use. So look for a supplies expense. That's letter P, and credit supplies, which is letter O. Last one said adjusted balance at the year end and service revenue account, 75,000. Give the journal entry to close this one account at the end of the year. So you'd be debiting the revenue. So there's N, and then look for retained earnings, and retained earnings is going to be letter K. That's going to be the credit for 75,000. I think that's it. All right, that was number 6. Here is number 7. They want the adjusting entry, and then they want the effect. If you had not recorded these, what would have been the effect on the financial statements? Would they have been understated or overstated or no effect? So in part 1, and these are for the end of the year. I always look at the dates. Always make sure you watch the dates. This is for the December 31st. So notice the date's July 1st. They've got a 2-year insurance policy for $600 paid in full to prepaid. Coverage began on July 1st. So on the first one, we got essentially a time period. That's going to be, I'll write this one out. So you've got July 1st through December 31st. So we know that's going to be 6 months of adjustment on that first one. So the adjusting entry, of course, it was $600. You do the $600. It's a 2-year policy. So divide by 24 and then multiply, of course, by 6. And then let me page down. I'll show you the entry. That's going to give you right at about $150 per month. So that's how you take care of that one. And then notice again, they are debiting insurance expense and crediting prepaid. That's part A. All right, part B. It says at the end of the year, they got unadjusted balance and supplies of 1,000. A physical account shows $300 were on hand, so we know they used 700. So look at your expense. You have supplies expense debit, credit supplies for the differences, again, is what you used. All right, letter C. It says they did some repairs. And again, I'm reading this right here. They completed repairs on one of their trucks. The garage completed repairs at a cost of $800. The amount is not yet recorded. It will be paid in January, but that's going to have to be an accrual. So we'll be looking for debiting an expense account and most likely crediting accounts payable. And that's what they did. They got repair and maintenance expense debit, credit accounts payable. This is an accrual for $800. All right, letter D says they completed a contract for an out-of-state company for $79.50 payable by the customer within 30 days. No cash has been collected and no journal entry has been made for this transaction. So the key in this problem says the company completed a contract. So that means that they've actually earned the revenue. So on letter D, you'll notice you've got to debit accounts receivable and credit revenue for what you've earned. Even if you haven't billed them or even collected it, you've actually earned it, so you get to record it. All right, letter E. We've got July 1st, they bought a new hauling van. Depreciation from July through December is $27.50, so they just wanted you to book the depreciation entry. So that's just going to be a debit to depreciation expense and a credit to accumulated depreciation. All right, letter F. It says we owe interest of $500 on a bank loan taken out on October 1st. It'll be paid when the loan is repaid on September 30th of next year. No interest has been recorded yet. So we got, again, $500 interest that we owe. That's just another accrual. So debit your interest expense and then credit interest payable for the $500. All right, letter G. Assume we've got income of $30,000, tax rates 30%. So you just take that 30% times that 30,000, so $9 grand. And so what you'll have is debit income tax expense and then credit income tax payable. So that would take care of the adjustments that you would have to record and then post. And the second question, of course, says, if these adjustments were not made, the financial statements could be materially misstated. Determine the amount by which net income would be understated or overstated had you not made these. So all you really have to do is look at what your total expenses were. Here's an expense, 150, 700, 800, 2750, 500, and then 900. Add up your expenses. And then, of course, you had a revenue that, of course, you would have recorded. So net the expenses against the revenue. And so what would happen then is they would have been overstated, looks like, by 5950. And of course, this is just that calculation right there showing you without the adjustments, without the revenues or the expenses, what would have happened to income. All right, that's my comments on this. Was again number 7. And then I believe the last 3 was all one problem, connected problem. So we've got a list of accounts with normal balances. And then on the first one, they just want you to do an adjusted trial balance. So you have to know which, of course, if accounts payable is a normal balance, you would know that that's on the credit side. And if accounts receivable, that should be on the debit side. So it's just, making sure you understand your debits and credits a little bit. So again, here is what your adjusted trial balance should look like. Note you are in balance by 10,400. That's the first part. And the second part, the retained earnings balance, of course, we know that's not going to be the ending balance because you have to update it by eventually when you do your closing and your adjustments. So we'll get to that in a moment. And then on part B, they said do the closing entry. So remember your closing entry, you want the temporary accounts. So you got 2 revenues, close those out, you'll have to debit the revenues. Then all your expenses should be credited. And on this problem, I'm looking to see if they've got a dividends. It doesn't look like they have any dividends. If they did, you would also subtract out the dividends. But in this case, we just have revenues and expenses. So the net effect here in the closing will simply be to debit the 2 revenues, credit the expenses, and then this $300, that's the plug number to get the debits to equal the credits. So $300 will be credited to retained earnings. All right, now the last one is simply just to show, you can see how that retained earnings should be updated by adding the $300 to it. So all that's left is your permanent accounts, which is your balance sheet. Notice all your revenue and expenses, which is your income statement account, are now at 0. All right, and I think that's it on my comments for the Chapter 4 homework.